Welcome to the Value Trades webinar for May. My name is Brad Alexander, and hope you're going to enjoy this. We're going to talk today about trading in volatile markets, and we couldn't have picked a better volatile markets because of what's happened recently. Over the years, as you know, if you're a professional retail trader or even just getting started, you will know that markets don't always behave the way you want them to. Markets are affected by outside influences, and we are in a time right now where we are in such volatility and uncertainty. And you'll find on Bloomberg they're always saying things like, we've never seen this before. Well, we have never seen this before. So what we're going to do is go through quite a few scenarios and hopefully give you some ideas on how to trade in these markets, and maybe not on how not to trade if you're so inclined. My name is Brad Alexander. I've been working with value trades for several years now. I'm a trader. I've been a retail trader and a professional trader. I've traded for American hedge funds, Malaysian hedge funds. I do enjoy trading. It's an interesting profession. Someday we'll have a webinar on how to make money with someone else's money on how to trade. It's good fun. I also provide content for many brokers and many fintech companies, including value trades. You may know my voice from Monday and Tuesday mornings, the Market Blast Technicals and Market Blast Fundamentals. One reason I mention that now is because I'm going to cheat in this webinar. I'm going to use a lot of slides that screenshots that I've used for the last two videos, and they are quite relevant because of the situation. So let's crack on with it. This is called an agenda. It's actually not an agenda. It's just the things I'm going to cover during this webinar because they're in no particular order. We want to talk about what exactly is market volatility. And what's quite important about this is there's a big difference between volatility and uncertainty. And what I don't want you to do is get mixed up by the two, because you can be very confused and simply not get it right. And the way we do that, you can actually measure volatility with various instruments. And one of the most popular ones, if you listen to Bloomberg or any of the other financial outlets, they'll be talking about the VIX a lot. And the VIX is an instrument developed by the Chicago Board of Options and Exchange, and it measures options on the S&P 500. And it's not just a measurement. Hedge funds and large companies will actually use the VIX and actually place options and trades on the VIX to cover themselves for short covering and basically volatility covering. We also have a thing called average true range, and I think if you follow along this webinar, you're going to be surprised by how I use average true range and how it gives you different readings for different types of asset classes. And I use average true range constantly when I'm trading, because I find it a very, very useful tool to gauge market volatility. The reason I got into average true range years ago was a guru of mine said to me, if you're trading, so for example, breakout strategies, and it's not working, the first place you should look is your average true range. If the average true range drops, then your breakout strategy simply won't work. You need to go to something else, like a longer term. So we're going to cover that in depth. Okay, in these volatile times or uncertain times, you need to alter your trading strategy. When things are ticking along normally, as I said, you may have a breakout strategy, you may be trading moving average crosses, you may be scalping, you may be position trading. You need to take in the current environment and perhaps alter your trading strategy, and even more importantly, alter your trading psychology. Psychology, as you may have found out or you already know, is critical to maintain your profitability as a trader. Risk management, again, with the markets the way they are, moving up and down, getting whipsawed in and out, you really need to watch your risk management. And we're going to go through some particulars about what that means and how to survive in the market. Fundamental analysis is always important. it's even more important now because there's so much going on, there's so much uncertainty and so much confusion that you don't want to be confused by rumors and innuendo and tweets and so forth that may affect the markets, and maybe just short-term influencers that will ruin your trades or blow up your account. That goes hand in hand, of course, with risk management. And what to trade. In these volatile times, it might be a matter of simply abandoning what you're used to trading and going to something else. It's not uncommon for a lot of traders to abandon equities and go to gold, or abandon gold and go to Forex, or vice versa. We'll go through what's happening in the crude market right now. A lot of people have lost a lot of money on crude, and a lot of funds have actually made a lot of money on crude. They may or may not have been trading it in the past, but they are now, or vice versa. So we want you to take a look at the different asset classes and see what's available to trade and how you can avoid falling into the pitfalls. And also, as I mentioned, trading psychology and volatility. Again, this slide is called Agenda. We're not going to actually follow this. We're going to be mentioning all these things as we go through the webinar. Okay, what I want to talk about right now is volatility versus uncertainty. There actually is quite a difference. So what I've done now, I'm going to show you 4 different charts. We have crude oil, and if you've been following the news, you will know that crude has been through the mill. It's the first time in history that crude oil futures have gone into negative. You remember about 2 weeks ago, or 3 weeks ago actually, the June future contract was minus $40. Well, basically, that was caused by 2 problems, and I'll go through that in a minute. It was caused by the problem of lack of demand for obvious reasons, and lack of storage, basically no place to put it. I wrote a blog recently on this, and I took the supply and demand strategy. Everything is supply and demand. Everything we do, everything we trade is supply and demand. Interest rates go up, the currency will follow and go up. Why? Because it becomes more desirable, the demand is higher. Interest rates go down, the currency is less desirable, supply and demand. Everything is supply and demand. Unfortunately, with crude oil, there was one more factor: supply, demand, and where do I put it? We've had a crisis recently where the storage is running out. We're going to go through that in a few minutes. So we are still in what we call a volatile situation with crude, mixed with uncertainty. And the reason that is right now is because there's a contract expiry. The July contract is going to expire in a few days. So basically, the July contracts will allow refineries to take delivery in June, and that's what happened 3 weeks ago when these contracts expired. There was physically no place to put the oil. So what a lot of the producers did was basically give it away. In fact, they had to do more than give it away. They had to pay people to take it. They had to pay people to take the contracts off their hands because there was no place to put it. And that was a huge, huge blow to the industry. Okay, if we look at indices, completely different topic. Indices, we don't have a physical thing to store. There's no storage problem. But obviously we have volatility and uncertainty with the indices. The volatility came from obviously a lot of market concern. How do we make things? We can't. Who's buying things? There's no one to buy them. Airlines simply stopped working. Cash flow became dramatically bad. Governments are having to bail everybody out, and it's a complete mess. And the thing is, we are now hopefully we're through the volatility with the indices, but we are now in a period of dramatic uncertainty. And we're going to go through that in a few minutes and find out what that means. I will also find that certain indices will be doing better than others, and I'll explain why. Okay, gold, that's another kettle of fish. Gold basically is the safe haven. It's the go-to asset when the going gets tough. And as you can see by this chart, Gold has been increasing for, well, roughly 3 years now. And I'm going to explain why we had that little dip a few weeks ago. Right now, gold, are we going to keep buying it? Are things more uncertain? They certainly are more uncertain, but gold may or may not have a future for the bulls. Let's see what we're going to do with that. And of course, we have Forex. Forex is basically driven by all the market factors that we all come to know and love: retail sales, interest rate decisions, and so forth. Of course, now Forex is being driven by everything else, by the strength of the indices, the strength of crude oil, the price of gold, and so forth. So all these four different asset classes are behaving differently in these markets. Initially, of course, there was a huge panic when we shut down our global economies and shut everybody else in their homes. I'm working from home right now. I'm sure you are as well. But again, all these four asset classes are behaving differently, and we're going to look at why and how we can take advantage. Okay, so let's try to understand the difference between volatility and uncertainty. You've heard the word uncertainty over and over again. Uncertainty certainly kills markets, but every once in a while we have a situation where we have volatility. And volatility recently, well, we're living through it right now. How has this started? Coronavirus causes a supply side crisis, was the initial thing. Initially in China, when coronavirus broke out, they had to shut down the factories, and suddenly everybody in the world who had a supply chains coming from China were in serious difficulty because they couldn't get the bits and pieces they needed from China. Unfortunately, at the time, they thought that was their biggest problem. Since then, on an aside topic, a lot of companies are looking at rethinking their supply side. Do we want to get it from China? There's a lot of innuendo and so forth going on about China. Did they or did they not cover up the virus? That's going to be going on for years. But the important thing to see in the markets is that if you're an American company or a UK company or anywhere in the world, and you want your bits and pieces to come out of China, and suddenly you've got a crisis like this, well, you don't have your supply. In fact, even Japan are they're putting in billions of dollars to encourage companies not to deal with China in the future, which is quite a serious thing to do, but it might be a way to spread the wealth around in terms of, where do I get my bits? Where do I get my semiconductors? Where do I get my plastic dolls for my Barbie case? Everything that comes out of China is now under question, and we will see in the next few months and years if that carries on. So volatility was created by the supply side crisis coming out of China. Right. Then there was a demand side crisis. The demand side crisis basically came from locking everybody in their homes. So suddenly we're all in our homes. We can't go out shopping. We can't go to the factories. Companies can't buy things from their suppliers, even if they could get them. So by this point with coronavirus, the supply side and the demand side had completely shut down. So we also know what's happened to things like the airlines. The airlines, they can't fly for all the right reasons, and they're hemorrhaging cash right now, getting government bailouts to pay their staff. So the volatility, if you're an airline, you're in serious trouble right now. In fact, if you talk to any hedge fund who are looking to get into the market, buying the bargains, buying the dip, they're looking at everything but the airline, sadly. And the way to look at that is that on the demand side, there's no one there to fly, and it's going to take a long time for that to come up. So if you look at the indices like the S&P 500, a lot of that index is based on airlines. Right. We talked about the next bit of volatility was the low demand causes the fall in crude oil. Well, again, we're not driving our cars, we're not flying planes, as I mentioned. The factories aren't running. There's really no demand for the crude. And again, The next bit, the biggest bit for the crude market, was there was no storage. All these towns in Oklahoma that were storing oil are now full to capacity. And interestingly, these towns, these storage facilities, were basically in question for the last few years. Now they're absolutely critical. You can't get in because there's no room at the table. So here we have all these things, coronavirus leading to various supply side, demand side, low demand, low storage, causing serious volatility in the stock, the equities, in crude prices, in gold later on, and I'll explain how that worked, and of course affecting Forex. So moving on to uncertainty. Well, there's a difference between volatility and uncertainty. And we have the usual things. I'm going to line these things up. So supply side uncertainty is still there, will still be there, even when factories get back into production. And it looks like many economies are trying now to get back in. But will they be able to get their supplies, get the factories moving? And again, we still have demand side uncertainty. And the uncertainty in this case is basically, if we all go back to work, if we all get back on the bus and get back on the trains, are we going to start spreading coronavirus again? This could be a very, very serious problem. We hear even today, Dr. Fauci was testifying to the Senate, saying basically, let's not do this, in complete contradiction to what his boss is saying. So, and again, the contradictions between President Trump, for example, and his team of experts causes market uncertainty. And this will be going on for quite a while. So it's not volatility, it's not driving the markets absolutely crazy, but what it's doing, it's keeping certain people out of the markets, it's certain decisions can't be made. And that's the nature of uncertainty since the beginning of time. If you have uncertainty, investors won't make decisions. And again, low demand uncertainty. I mean, why, there's no point in stocking up your petrol station and so forth. There's no one's going to come to buy it. If you're in the food business, that's very different, obviously. And again, we still have the situation with storage uncertainty. There are a lot of, and I mentioned crude oil and storage in Oklahoma. Obviously, that's WTI. If you're dealing in Brent and you've got a lot of ships floating around the oceans, putting around, and ironically, the biggest users right now, probably, I'm saying this tongue in cheek, of oil right now are the ships that are storing it, floating around. So never mind the fact that we need someone to actually use this oil, airplanes, factories, and so forth. We still have to store it, and that's still causing uncertainty, keeping the prices low. And let's add one more little factor in with uncertainty: U.S.-China trade. If you've been doing any kind of trading for the last couple of years, you've probably been thwarted by U.S.-China trade uncertainty. I know I have. You're in the middle of a trade, things are looking good, and suddenly Steve Mnuchin puts out a statement and the markets go the other way, or Donald Trump sends out a tweet, or he says, oh, we're doing really well with U.S.-China trade agreement, markets go up, and the Chinese come back and says, well, no, we didn't hear anything about this. This U.S.-China trade uncertainty is still there and will be there for some time, sadly. And from an investor, from a trader, from a person living on this planet, right now, that's the last thing we need. Okay, let's take a look at the VIX itself. I won't spend too much time on this because it's not something that Value Trades offers to trade, but it's very good to be aware of what it is and how it works. In the past, I've actually traded the VIX, and I've done well on it. But what I want to show you, and this is a chart showing the VIX over the last 4 years. The normal range of the VIX is about 12 points. And again, this is a volatility index based on the S&P 500 and who's buying and selling options. And if you notice on the where I've written the text normal range, the low end dips down slightly, and that's due to contango, and I'll go into some details on that a little bit later. but I want to show you, and the VIX can be difficult to trade. It can be easy to trade. If you're sitting hoping it will to go long on the VIX, and you have long periods of low volatility, you can actually whittle away at your capital. It's very difficult. You have big spikes in the VIX for various reasons, and you want to go short. That can be a very good thing too. But then the question is, it's like anything, where do I get in? What's the top? Where's the bottom? It's a tricky one, but it's there. The VIX was developed for funds and companies to protect themselves in times of high volatility through the Chicago Board of Options and Exchange. Right, here's a spike from August 2015. There was a big crash there, and you can see that the VIX went up to 56, and that was at the time, that was huge. That was what they were saying at the time. That was the biggest crash since the Depression. I'm not sure if that's true, but I did trade that, and I'm going to show you some charts a little bit later as to what exactly happened and how that worked. So at the time, that big spike was huge, 56 points on the VIX. In February 2018, we had another crash, and again, it was in the 50s. I actually personally did quite well on that because I was trading the VIX at the time. And again, December of 2018, we had another crash, not so bad. That was to a point of 36 on the VIX. And that again was due to US-China trade problems. So it's not that we're used to it now, but if you notice the spikes on the VIX throughout 2019 were a little less because the market got used to the fact that US-China trade relations were up and down and rocky. And we all know why. But let's take a look at what happened next. The coronavirus, it sent the VIX to a grand total of 84. I mean, I have seen that in the past, but that's territory that we haven't been in for many, many years. And that's a big problem. Obviously, it's come down now. It's come down to 26 today, which is better, but it still shows volatility in the equities. Again, the VIX has nothing to do with commodities and has nothing to do with Forex. It is literally looking at the S&P 500. In fact, I heard a joke today, and they're now calling it the S&P 5 because basically 5 companies are driving the S&P 500. Right. Speaking of the VIX, going back to 2008, it did once go higher, and that the day Lehman Brothers went out of business, the VIX spiked up to 96, and we all know what happened after that. Basically, the global economy went in for a very, very rough time. It was rather unpleasant for a lot of people. I had a business myself, and I know for a fact that my phone stopped ringing the day that Lehman's went out of business. So we went through a few years of lean times. Right, I get asked a lot. Speaking of which, what is the difference between 2008 and 2020? Okay, we looked at the VIX. We've seen a very similar situation, massive volatility in 2008, massive volatility in 2020. Well, the difference is this. In 2008, we had a banking crisis. We had basically thin ice and boiling water below it, if you can take that metaphor seriously. The banks were completely unstable. Many economies were unstable. Regulation was a bit of a mess. If you watch the film The Big Short, you will see why we got into this mess and what happened as a result. Fortunately, past 2008, the banks have been completely re-regulated. Things are much more stringent now. So, and they have stress tests. Every central bank has stress tests for the banks in their individual economies. The Bank of England looks at all the banks in the UK. The Fed looks at all the banks in the United States. And fortunately, we can say that it's led to, among other things, a very strong economy in the beginning of this year and very good control with the banks. What happened in 2020, where we are right now, is a health crisis, which has led to an economic crisis. Fortunately, the underlying economy, it's incorrect to say it's still there because it's not. Let's face it. There's going to be some problems, a lot of people out of work, and a lot of companies will go to the wall in bankruptcy. But what we're hoping, obviously, is that we come out of coronavirus and be able to pick up where we left off. That's not going to happen. But let's put it this way. If coronavirus struck in 2008, it would be a very different story, completely different story, because the economy simply would have failed dramatically. At least now we have some chance. So let's see what happens in the next few months with our going back to work. Okay, I mentioned we've talked about the VIX quite a lot. Let's take a look at average true range. And what I'm going to do now is switch screens. Okay, here we have a Value Trades MT4, which you're all familiar with. So what I've done, if you know me, I love profiles. So I've made a profile called ATR, Average True Range. Okay, let's take a look at all the. Okay, so what I've done is put a mixture of assets, of instruments on average true range. The way to measure average true range, in fact, let's just take a look under indicators. You leave average true range on a daily chart. It really has to be on a daily chart, and I've left it at 14 periods. So basically what it's doing is looking back at the last 2 weeks. Whoops, we don't need that. We don't need 2 of those. Okay, what I'm going to do, I'm going to take a look at gold right now. So we're going to expand this. And I want to show you a couple of things about gold. In fact, I'm going to deviate from my talk on average true range just for a second. We see that the price of gold has been going up, 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 up for a very long time, 2 or 3 years for that matter. So we all know that gold is a safe haven currency. When things get tough, people buy gold, simple as that. I remember trading it not long ago when it was, yeah, well, in fact, here it is here, $1,176. Now we're up to $1,700. Okay, so why then did we have this big dip? What's the reason for that? Well, basically, it was a sell-off. And what happened was when coronavirus really hit home, right about here, when everybody decided to shut down their economies and the markets decided, or the market started tanking and we started losing a lot of on the equities, a lot of hedge funds, a lot of people who own gold had to sell it. They had to sell it very quickly because they had to balance their books. So the money they were losing, because they live and breathe for their investors and shareholders. So the money that they were losing on Forex, on indices, on commodities, equities and commodities, they had to find somewhere. So the best way to find that, and they sold off their gold. So we had a big sell-off in gold. So that's why the price dropped. But what I want to show you right now is quite interesting. Even though we were in times of complete turmoil, support and resistance still apply. And we're going to be talking about how to trade and what to trade and what to avoid. I'm going to be talking about indicators, how sometimes indicators don't work in volatility. In fact, they almost never work in volatility. They often will work in times of uncertainty, but support and resistance is the key thing to be trading with day in, day out. If you're not using support and resistance, you may be making some mistakes. Simple as that. So what I want to do now, let's get back to average true range. So if you can see this on the screen, if we hover over what the average true range normally is, it's measured in points. It's about 10, 24, suddenly jumps up to 66. So that's basically $66 of range per day when we like it to be around $12 in range per day. So when we talk about volatility in the markets, in the commodity markets and Forex markets, we use average true range. So if certain strategies aren't working, I want to go and take a look at average true range to see what's going on. Why isn't my strategy working? Well, here we have a massive spike in average true range, and we know why, because everybody and their brother had to unload all their buy gold quickly because of the uncertainty, and then sell it because they needed the cash. So when you hear the expression go to cash, that's what's happening. Now we're down around 27, which is sort of a normal level. So when I see average true range dropping into a level like this, it's actually comforting. But again, there are a lot of other factors. So what I'm going to do now is go back a bit and take a look at what gold is done. So remember that number. That number was $67. I'm going to turn off my scrolling and go back a bit. Oops. Okay, here's another peak where gold investors jumped into the market, and we look at average true range, and we see that it's 16. Excuse me. Looks like a big peak, but the average true range only jumped up to 16. So compare that to 67. Here we have this little spike here, this little whipsaw. This was the US election. And a lot of people went to gold with the result of the US election because of they needed some certainty. They were afraid of what might happen to the equity market, so they went to gold, and that jumped up to 24. So you can imagine the panic in the markets when people were buying gold and the ATR went to 24. Now it's at 67. Big difference. Okay, keep in mind that the average true range is a 14-day reading. So if something happens like a big spike, it takes 14 days before it calms down. So very quickly, we've looked at gold, and we can see that we had a big spike in average true range, and now it's coming back to something that's fairly normal. Right now, I'm going to look at oil. Okay, again, oil, normally the average true range, and this is US oil future, so it's a WTI future, and this is based on a 2-month contract, so this would be a July contract that Value Trades has put up recently. So it likes to be around 1.7 as an average true range. What it's done recently is jump up to 5. So the average true range has jumped up dramatically. You remember gold actually dropped down. Well, oil is still high. In fact, we're looking at, this is a daily chart, so we're looking at less than a week ago, it was still up over 5. It's come down a little bit. And the reason that there's still a lot of range with oil right now is the market is quite uncertain about what's going to happen. So we would consider this to be, I would consider this to be a volatile market, because we really don't know what's going to happen. And if I go back and look at some other instances, here we have an average true range. If I can get it to work, of 2. So it looks like it's quite a peak, but that 2.6 really doesn't compare to the 5 that we're at now. Right? Let's take a look, and UK oil will be about the same. The pattern's a bit different. The prices are a bit different, but the rationale is the same. If we look at the S&P 500, we have exactly that. We had a massive sell-off based on coronavirus. Most of it, of course, caused by the airlines. Lots of panic going on, and everybody was selling. Everybody was going to cash. We saw the same thing happen in 2008. Fortunately, it wasn't as bad as 2008, but the average true range on the S&P 500, 230, and normally we like it to be around 42. So there was a huge jump in average true range. But the thing is, it's come back down. If we look at where we are now, it's 70, still pretty high, but it gives you some idea that the markets are becoming a little less volatile. The thing we need to worry about now with the equities, again, as I mentioned earlier, if coronavirus comes back and our attempt to go back into production, into real life is thwarted, it's going to affect the equities badly. It's as simple as that. But a lot of investors are getting into the market. And again, here's another difference between 2008 and 2020. There is a lot of cash out there and a lot of people taking advantage of the bargains. This is why the equities and the indices are all going up. It's a good sign. It's a comforting sign. Is it true? A lot of analysts are saying, no, it's not. They don't understand it. But let's see, because, and the other rationale as well is when And I look at the indices all the time if you watch my videos, and Value Trades offers quite a few indices on their list. Let's take a look very quickly. Let me just view. Oops, excuse me. We're viewing Market Watch. We have the DAX, we have the Nikkei, we have Hong Kong, we have the Stocks 50, Australian 200. Okay, we also have some new ones that Value Trades has put on. The China A50, the outside of China shares, the CAC we knew. We have India, Singapore. We have all these indices that we like to trade. In fact, if you look at the charts, you'll find that they all look sort of similar. The patterns are almost are very similar. But if you look at the S&P 500, you'll find that it's actually doing better than all the others. It's getting closer to its 200-day moving average. So you'll find that Wall Street and the S&P are doing better. What's going to happen, and this is my own opinion, but I have a feeling it's going to be set true. When the dust settles, there'll be a lot of smaller companies, medium-sized companies that simply will not be able to handle it. They will go into bankruptcy. They will need to merge with other companies, and the larger companies will then be taking over the smaller companies. It's simple as that. If we think we're in a science fiction film now, we may be in another science fiction film where we have large companies actually running countries, and I'm not making this up. Some countries are in such trouble right now with their sovereign debt. And for example, Nigeria, their revenue is based on oil. Well, they're in serious trouble. Who's going to bail them out? The IMF doesn't have enough money. Who can do it? Large companies. Again, this is pure speculation, but let's see. So this is why a lot of investors are investing in larger companies, because they think that they're going to be coming out of this in the end successful. It may take 5 years. It may take a few months. We just don't know. Okay, getting back to average true range, here we are. So we said 75 was our comp, was where we are now. And if we look back at a big spike back in the end of December, which again was the US-China trade problems, it's the same number. So here we are in US-China at the end of 2018 with average true range of 74. We thought that was huge. Well, that looks like Bambi now compared to what we just went through. Right, let's look at Forex. And I'm showing you now two of them. Euro yen, again, average true range of 207 pips. Seems like a lot. Yen pairs will give you a lot of average true range in numbers, but don't be fooled by the numbers. It's all relative. What we like to see with a normal market is about 59 pips, 60 pips. Here we are, 100 pips. We've come down now to 100 pips. So here we have a Forex pair that is calming down. If we look at euro pound, I show euro pound very often because it actually has a very low number. But so if we're looking at average true range of 72 pips, 40 pips, jumped up to 213 pips. Now it's come back to, things hover over 65 pips. So it's back to normal. So this is important to understand. Not all the Forex pairs are back to normal, but they're quite close. So this is very important if you're looking at something to trade. If you're scared of trading oil, which you should be, if you're not sure about equities, Forex is now back to normal. And again, this is where we differentiate between volatility and uncertainty. Here we had an average true range, very high, huge spikes. What's going on? Where are the central banks going? This is crazy. This is nuts. This is volatility. Now we are in a point of uncertainty. Obviously different to trade, in some ways easier to trade. But again, I'm going on about this, but average true range on the daily charts can be a very, very valuable tool for you. Let's get back to our show. Right, I'm going to show you a sample trade that I actually did in 2015. I talked about the market crash in 2015, and this is a true story. I actually did very well on this trades, I should say. And this is, I hope, a good lesson for what's happening now, or what could happen, or what did happen. And again, I based this trade on a pennant. I love trading chart. If you see my videos, you know I love trading chart patterns. So here we had a pennant, and I went short. And lo and behold, yes, I got lucky. For the next 3 days, sorry, this is the S&P 500 on a 4-hour chart. For the next 3 days, the market crashed. And here's my strategy. And I got in and out, basically 4 days. I got in off the bounce off this upper trend line, and then I wrote it for the first day and then closed the trade. I got back in day 2, closed it, got back in day 3. And the strategy was super, super simple. I woke up in the morning and took a look at the Shanghai Composite. If it was just as bad as the day before, I went short on the S&P 500. I would not recommend that strategy right now because things are very uncertain in China, but it can often work. In fact, I'll be honest with you, I actually did that strategy for a couple of months, and then suddenly it stopped working. If you can find a pair to correlate, oil versus Canadian dollar, Shanghai Composite versus S&P 500, you can actually take advantage of moving markets like this. But I want to show you something that's really important now. So again, I did very well on these trades. Right. So on day 4, or day 5 actually, Bloomberg came out at this point and said, that's it. Markets are calmed down. The investors are piling in. Everybody's investing. We're all going to be back normal again, blah, 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 blah. Fortunately, I ignored that. And look what happened. If you look at the candle next to that blue line, the market crashed and went back down to 1860 on the index. So I'm not saying that Bloomberg don't know what they're doing. Obviously, they know what they're doing. They're very good. They're very professional. But every once in a while, you get a news story that is completely erroneous. And I'm going to share another one with you where during the Greek debt crisis, the euro was collapsing. It was in a serious mess. And it had come to the point, I don't have the chart in front of me, but it had come to the point where it was obviously in bad situation. Bloomberg came on and said, and again, I'm picking on Bloomberg only because I listened to them, said, that's it. Investors are piling into the market. The debt crisis is over, et cetera, et cetera. And a lot of people lost a lot of money because they listened to that. And unfortunately, they didn't have the Greek debt crisis settled. It took another few months before they did that. And those who went long on the euro actually had their accounts blown up and so forth because they listened to the news. And it's a hard one because you want to listen to the news, but you have to be very careful. And I'm going to show you what to do to cover yourself in situations like this. So if we move on, and one more thing, I did get into this trade again right about here, and I went long on the DAX and did very well. So I was actually, because I was very careful, I did not put in massive position sizes. I actually made 4 very, very nice trades. And after I finished those, I stopped trading for a few days. Right. In times of volatility and uncertainty, we're going to go through a list right now, but I want you to be very aware of some of these things. Sometimes it's a good thing to step back and wait for direction. If you jump into the markets because, oh, it's moving, I've got to get in, this is a once in a lifetime chance. In situations like this, it could go the wrong way. Very often you need to step back, let the dust settle, and wait for some direction. Yes, sometimes you'll miss a great trade. Other times you can blow up your account. That's the markets. Get used to it. My rule of thumb is there a place to put a stop loss? Simple as that. If there's no place to put a stop loss, if price hasn't given me some idea of direction or reversal, then I don't want to know about it. I'm not going to jump into a trade just because things are moving in a certain direction. Yes, sometimes you kick yourself because you didn't get involved, but at least wait for a pullback. Wait for some place to put a stop loss. Spend extra time planning. Again, jumping into the markets can be devastating to your account. You'll find now that economic news events, and if you know me, you know I love trading economic news events. I love trading pullbacks on counter trend movements. You'll notice now economic news can also almost mean nothing. I mean, we have massive non-farm payrolls reports that are just devastating, and they really haven't moved the markets much. And again, you're going to hear the phrase baked in, priced in. It's already priced in. So until the markets get back to normal, trading economic news events may not be your thing. But you still need to spend extra time planning. Again, you may want to look at different instruments. If you're used to trading gold and you're not sure what's going on, then go to the Australian dollar. If you're used to trading oil but it's all messed up, go to the Canadian dollar. Find something else to trade. If you're a scalper or an intraday trader and you're confused, then look at it as an investment. A lot of people are now saying, well, I'm going to go long on the indices because it's all coming back, or I'm going to go long on oil because it can't go any lower. It can. Personally, I don't want to give too much trading advice, but I'd like to go long on oil, but I want to wait until the next contract expires because we just don't know what's going to happen with the storage. Don't be seduced by the volatility. Again, I mentioned earlier, you want to jump in because it's all crazy, it's going fast, it's fast. You can blow up your account very easily. If you don't know, don't go. Sometimes the best trade is a trade you didn't make. And the excitement can blow up your account. We're going to talk about that in a minute, about how to blow up your account. Widen your stop loss. Again, with all the volatility, you will see that your stop loss needs to be placed in a certain place. I do a bit of work with professional traders who trade nothing but fundamental analysis. And they're all ex-hedge fund guys, and they trade professionally, of course. And they use massive stop losses. They will look at 1% of their account on a trade, but they're not going to set a 10 pip stop loss or a 50 pip stop loss. They may set 100, 50, 200 pip stop loss because they want to make money on the trade, but they also know that the markets don't always go in the same direction. They don't always go in a straight line. Reduce your position size. If you've had any of my videos or webinars on trade management or trading psychology, position size is the biggest killer that there is. If your trading position size is too high, you will blow up your account. And with this in certain uncertainty and volatility, you need to reduce your position size. Right. Move to a higher time frame. Eliminate the noise. If you're used to trading intraday and you like the 15-minute charts, you may want to move out to the 1 hour or 4 hours. Again, avoid rumors and opinions. They can also kill. You don't want to jump in on something. Oops, I've got a line out of place here. Right. Let's look at the current situation and how we can apply what's going on. Okay, we talked about the indices, and again, this is a slide from one of my videos. So on the left, at the top left, we have the price. I say price action. It's the actual index that's actually close to the 200-day moving average, and that is the S&P 500. And as you can see, everything is going up. But don't be fooled by that. If we have another coronavirus breakout, increase in cases, this may change. Again, we saw the big crash and the markets moving back up. But what's important to understand is that we are still looking at levels of support and resistance. This is still important to be aware of. Even though we're in interesting times, you still need to be aware of where we are with your moving averages and your support and resistance. Okay, here we have our 4 charts on crude. So we have US oil, which is a futures contract. We have UK oil, which is Brent, another futures contract. We have US oil cash, which is the spot price. And you will notice that there's about on today, about a $5 difference between the two. That can actually go higher. It was about $9 a while ago. And Brent, and I was very pleased to see, if you caught my video yesterday, that the difference between the spot price on Brent and the futures contract on Brent was about $1.90, which is very low, which is very good. And we call that contango. where the futures price is higher than the spot price. So when contango starts to get smaller, that's a good sign. But again, on crude, you still need to be aware that there is still some danger with the storage issue. Again, if we all go back to work and start driving our cars and start flying in airplanes, the demand will increase for crude. Experts are saying that it'll take 3 years to clear the existing inventory. Right. Here's another thing to look at is that some currencies, some countries are in serious trouble. Here we have dollar Mexican peso, and you can see what's happened. The country is in serious trouble. They're going to have to borrow a lot of money very soon just to maintain their economy, which is making their currency very, very weak. Okay, is this a good trade? Do you want to short dollar peso and get it on the rebound? Maybe you could. All I would say is make sure you've got a very low position size because you'll make up the difference with the fall if it does come back. Make sure your stop loss is very wide, well above any kind of resistance that you may see. Look back on the monthly and even the weekly and monthly charts to see where resistance used to be. If you think the situation in Mexico is going to get worse, then you might want to go long on dollar mex. Anyway, be careful. It's an interesting thing to look at. Look at the spreads. That's another option, is looking at exotic currencies that of countries that may or may not be in trouble, because fundamental analysis on these currencies will be key. And again, big companies may come in to bail out other countries, and big companies may come in to bail out these other countries. Mexico is not a small country, but you'll see a lot of activity going on. Okay, here we have a situation in Forex where we saw Euro Aussie spike quite a lot. Oops, sorry about that. But we still have a situation where we have basically the basic technical stuff. We have a downward trend. So we've got a situation where you can actually trade the trend. What I would do in this case, obviously, we're sitting at support, and this line of support obviously is quite strong because it was resistance back in January. So you're still, even though we're in uncertain times, we're not sure what's happening with the euro. The Aussie dollar is going to be affected by China trade, also by the price of gold. We still have fundamental and technical analysis on our Forex pairs. And you'll find now that Forex might be not easier to trade, but definitely easier to trade than, say, the indices or oil or gold. So I would say dip a toe in, keep your position sizes low, make sure your stop losses are wide. On this case, you might want to wait for a bounce, a retracement, and wait for a bounce. The trend is your friend, and short Euro Aussie. Not now, because right now we're sitting at support. Going short when you're this close to support can be a fatal mistake, because if it bounces up, you're going to hit your stop loss. Wait for a retracement. I'm showing you that as an example of a Forex pair. Okay, here's our old friend gold. As I mentioned earlier, we had situations with gold where the big sell-off occurred. Now people are still in the gold market. We're at 1700. But what I'm intrigued in is by this consolidation pattern. So again, it's going to be tricky. Always look at your fundamentals before trading your technicals. But when I see consolidation like this on gold, it's an interesting thing. So if the news is good coming out of various economies, the price of gold may come down. If a war breaks out somewhere, like usual, gold may go back up. But one thing that I and a lot of gold traders are going to be aware of is that if a lot of countries get into some big problems, if I say central banks get into some big problems, they may have to sell gold just to pay for rebuilding their countries. It's as simple as that. And over the last 3 years, a lot of economies, Russia, China, a lot of Kazakhstan, I could go on, the list is lengthy. If you saw my gold webinar a few months ago, there is a lot of gold purchasing that has gone on the last 3 years. If they start selling that off, the prices will go down. I can't honestly say when that's going to happen. No one knows, but they may have to. Okay. Again, you say, well, it's at $1,700 now. How can it go up? Well, if I look at the gold chart from on the weekly chart, if you look back 8 and 9 years, you'll see that gold was about $1,900. That's a lot of money. That's a lot of money for an ounce of gold. For 2 years running, it was very, very high. So the levels we're at now are not uncommon. They're not pleasant, but they are not uncommon. Is that to say that gold is going to go up higher? And again, you'll see the timing is not after the end of 2008 and into 2009. The price of gold went up based on what happened to Lehman Brothers and the global economy. Quite logical. So I've fallen behind. I'm sorry, I've fallen behind on my my text. So I'll wait for the sell-off. Okay, here we have dollar CAD, and again, it looks like a normal Forex pair. But if you do any trading on any Canadian pair, you'll know that it is affected by the price of crude. And basically, dollar CAD is in an inverse correlation to crude. Very often, if you watch my videos, I've got the dollar CAD chart up against the price of crude. You'll notice now that it's a bit out of whack. It's not really following. But the bottom line is, if the price of crude goes up, the Canadian dollar will go up, and dollar CAD will come down. And again, getting back to normal trading, we're in a descending triangle. You may want to trade the bounce off this upper trend line if it reaches that far. Let's see what happens. Right, I'm showing this now. If you see on this chart, I've got a stochastic oscillator, just as an example. You'll find that in times of high volatility, war breaks out, coronavirus, indicators can be almost useless. It's as simple as that. I've said be careful with indicators in volatile markets. Basically, I was being polite. They can be almost useless. However, even in uncertain markets, indicators can be useful. If you, I like the stochastic oscillator. It's on this chart now. If you go to your MT4 after this webinar and line it up, do some back testing, you'll find that it's a very good indicator to show you when reversals are happening. As long as you follow the trend, if you want to use some other indicator like Bollinger Bands or moving averages, I always go to my stochastic oscillator before I make a decision. In fact, I may often even use a stochastic oscillator on different time frames. And again, as I mentioned earlier, if you're trading in uncertain markets and volatile markets, go to higher time frames. And as I mentioned, support and resistance, even in these times, is very, very important. In fact, if you look at this chart now, this chart spans pretty much most of this year, but the major volatility that's been happening, or the major price action that's been happening, has been around here in times of coronavirus. You'll still see that we still have trend lines and we have support. So this is still quite important to follow. I cannot stress enough how important support and resistance is and will always be. Okay, here we have a pair I mentioned earlier, Euro Yen. Again, the same thing. We're in a downward trend. No reason why you shouldn't trade this. Again, watch your fundamentals. See what's happening with the euro. What's the European Central Bank going to do? You know, what mood is Christine Lagarde in? What is Kuroda going to do in Japan? As you know, the yen is a safe haven currency. If things go sour, people may be buying yen, which will drive this higher. But if we look at the difference between the euro and the yen, it's entirely possible that this pullback will continue into a downtrend. Again, if I'm going to trade this, I'm going to be very careful, low position size, find a big fat place to put my stop loss, maybe up here, because I don't want any surprises. I like the fact that we're in a downtrend, but under the circumstances, I'm not taking anything for granted. And I'm going to end this webinar with my very favorite slide of all time, and this is gold from 2014, and this slide has everything in it. Basically, I was trading and I found this beautiful pennant, and I put on my journal, my spreadsheet. I said, take a look at gold on Thursday. Well, guess what I didn't do? I didn't look at gold on Thursday. I forgot, and what happened was this massive gap. And I'm sorry, I've forgotten why, but the price of gold dropped dramatically. Right about here, the tensions in the Ukraine escalated and the price of gold shot right up. I'm very happy I got in, one of the biggest trades I ever made, and I got out about here. Obviously, if I'd stayed in longer, I could have made more money, but I got out. And again, that is a perfect example of volatility and how to take advantage. Bottom line, when there's massive geopolitical tensions, the price of gold will go up. Again, we are in a situation right now, we're not looking at wars, we're looking at a pandemic, we're looking at a very complicated situation with the central banks, with the hospitals, with the airlines. So there are no guarantees, but this is a perfect example of how to trade in volatility on gold. So that's basically it. I hope I've covered everything you wanted me to go through. It's quite an interesting topic. You have to be very careful. And if there are no questions, I'll wrap it up. If you have any questions, just simply type into the question box, and I will happily answer them now or get back to you. No questions? Okay, well, thank you very much for your time. Hope you enjoyed it. And this, tell your friends this webinar will be available on recording on the Value Trades website. Okay, take care.